Mohammed, welcome to the show. How are you?
I'm well, thanks for having me.
Okay, it's so fantastic to have you on. I've watched lots of your TV, podcasts, everything. It's fantastic to have you here today with me. It's brilliant stuff. So you're here primarily because we're partnership with the FT on Business Book of the Year award. But before we get started on that, I just wanted to, especially for people who may not know who you are, and I'm sure there's probably a very few at this stage, but you've got a fantastic background. So as far as I understand, you were born in the US, you have Egyptian parents, you went back to Egypt, and then somehow ended up at a UK boarding school. Can you tell us about that?
That's right. I was born in the US. My father was a lawyer, an international lawyer, and he was in New York, and I was born there. We went back to Egypt, and then he was a professor of international law, but got drafted into the Foreign Service. So we started moving around. And as we moved around, I found it harder and harder to adjust to new friends, new languages, new school systems. So when we were in Paris and he told me that we were being transferred to Switzerland, I asked to be sent to boarding school. He said, "Where would you like to go?" I said, "The US," because we had been in New York beforehand. He said, "Too far, too expensive." And without knowing what I was saying, I said, "The UK." And he said, "Is that your choice?" I said, "Yes." He said, "Do you own it 100%?" I said, "Yes." And next thing I know, I went to boarding school in the UK.
And how was that? Sorry, when was that? Was that back in the 80s or
I
earlier?
wish it were in the 80s. It was in the 70s.
Oh, okay.
And it was a big shock to the system, to put it mildly. I arrived, I remember our dormitory were 52 beds, no heating, bathrooms outside. Um, it was character building, I think is how I would describe it.
Well, obviously being from the UK, a different place then from what it is now.
Oh, very different. Very,
Ah,
very different.
okay, thank God, relief. Okay, and you have a degree and a doctorate in economics at Oxford, but you've also got an undergraduate at Cambridge. So
That's right.
how
I
did
went
you
to
end up playing
Cambridge.
both sides?
So I went to Cambridge and to do my undergraduate in economics, probably the most transformative time of my life. It was an incredible unleashing of intellectual curiosity, of stressing not just what you think, how you think. I was going to stay there to do my doctorate, but then I fell in love with this wonderful lady my last year who was going to Oxford. So I scrambled to get my grant, move to Oxford, find a college, and then I was dumped on the second day. So it was a really good experience in terms of never make a decision based on one variable alone. And then I stayed in Oxford and did my MPhil and my doctorate.
Um, I'm sure there's a lot of people out there feeling the same heartache you probably felt back then. A life lesson for you very early on as well.
It was a good lesson, a very good lesson.
Okay, so we're mainly here to talk about one of your books that you've written. You've written many best-selling books. This one was back. Well, it was When Markets Collide, but it was released in 2008. But I presume you probably started at least a year or two or three before that. How long before it actually came out did you start writing that?
I started in 2007. I was worried that the financial system was decoupling completely from the underlying economy, that we even stopped calling it financial services. It became finance, as if it was the next level of capitalism. I saw countries compete to be the biggest financial system in the world. And if it was a multiple of their GDP, it didn't seem to matter. Think of Iceland, Switzerland, Dubai. And I started getting really worried. And the book was an attempt to try and play this through and ask the question, what happens if we don't get a course correction?
Okay, so in the book you talked about new realities. I just wonder what we 15, 16, 17 years on from when you started writing it, how many of those new realities that you spoke about in the book are we now living with at this moment in time?
Well, we're still living with the big one, which is that finance is too big. that we've over-relied on finance and we've underinvested in the genuine drivers of productivity and growth, infrastructure, people, innovations. That's changing. I think there's now a recognition. But when so the book came out in March, I think, of 2008. We had the financial crisis in the summer and September when Lehman Brothers went down. And this was an opportunity to resize the financial system. Instead, two things happened. One is public balance sheets started substituting for private balance sheets. So we blew up the balance sheet of central banks to 9 trillion, in the case of the Federal Reserve, for example, from under 2 trillion, trying to maintain this finance-based system. And then the second thing is that while we tried to de-risk the banking system, we didn't pay enough attention to the non-banks. So what happened is that the risks in the system morphed and migrated to something that was even less well regulated. I think this is much better understood today. So today there's much more emphasis on investing in genuine drivers of productivity, not just finance. There's an understanding that we have to oversee the non-banks better, that there's a lot of risk-taking that goes on there that provides for systemic risk threats. So we've come a long way, but it's taken much longer than it should have.
So do you actually think that we have countered some of those issues that we saw like 15, 16 years ago?
To some extent, but it's taken a very long time. You know, I remember the mantra coming out of the financial crisis, which was the 3Ts. Policy should be targeted. Everybody agrees on that. Should be timely. Everybody agrees on that. And then was the third T, should be temporary. There was this notion that what the West had experienced was a cyclical shock, not a structural shock. And cyclical shocks are like elastic bands. You stretch them, they go back there. So the notion was, oh, all that policy needs to do is stabilize the system, and the system will reset. There wasn't an understanding that the system itself was out of whack and that you needed fundamental reforms. And that's why we got stuck in what my colleagues and I call the new normal, which is growth didn't come back in a durable, sustainable, and inclusive manner. And now finally, growth has become a mission. There's now recognition that we have to put a lot more emphasis on growth.
So given what you just said, were you quite worried when central banks talked about transitory inflation?
I was, because we were repeating the same mistake. We had a shock and we immediately assumed it was going to go away quickly. And I remember at the time, and here we're talking about March and April of 2021, and I wrote that in the FT and elsewhere, saying keep an open mind. Just keep an open mind. Don't rush to judgment. Then by May, June, July, the companies were warning that their costs were going up in a significant manner and that they had confidence they could pass on the higher costs into higher prices. And they were confident that these prices would stick. And I kept on saying, listen to what the companies are telling you. Don't just take the easy way out, the lazy way out of saying this is transitory, this will just disappear on its own. And it took till November of that year before the Federal Reserve Chair, Jerome Powell, went in front of Congress and said, we are retiring, his word, retiring transitory from our vocabulary.
These are intelligent people. So where did it go wrong? What did they miss?
So I think the Fed in particular suffers from three things. One is groupthink. Unlike the Bank of England's Monetary Policy Committee, there are no outside members. And just the same people meeting in the same room, and the incentive system is always to find some sort of agreement. We've seen this again these days at times when the Bank of England has decisions that are 5 voting for one side, 4 for another. The Fed has everybody voting for the same thing, where we know that these judgments are much more balanced. So the first thing is just simply groupthink and not having enough outside members to challenge. The second is a lack of cognitive diversity. There isn't enough cognitive diversity in those institutions, which means that when something happens that is out of the normal range of distribution of outcomes, people don't see it. They redefine it. They fall into all the behavioral traps that I've talked about in the book of reframing it in a way that you understand. It makes you comfortable, but you lose sight of what's important. And then the third issue has been a bit of hubris. Central banks have been, quote, the only game in town for a long time. And they sort of grew into this state of hubris. There was a report issued by the Fed when the Fed failed to see the banking problems in 2023 in California. And the Fed was there. And that report, which goes on for more than 100 pages, written by the Fed, rather because they wanted to preempt a outside body writing it, just shows you what happens when you lack that external perspective, when you lack that intellectual curiosity, and you simply reframe things to feel more comfortable.
Okay, you talk in the book a lot about signal and noise. At this moment in time, what are you considering noise? And is there anything you're considering signal at this moment in time?
So I think the signals are the fundamental transformations that the economies are going through. And I think of it as a set of factors that's shaking us from above and a set of factors that's shaking us from below. From above, these are factors that will change how we do things. It's about artificial intelligence. It's about life sciences. It's about sustainable energy. They don't impact just what you do, but they impact how you do it. And that is a fundamental signal that all of us should be more prepared to course correct in how we do things. We're being given tools, incredibly powerful tools, that we need because we have incredibly big problems. Then you have a certain number of sectors from below that are being shaken because they're not working well. And they typically have what economists call externalities. They typically have lots of spillovers. Healthcare is one of them. Defense is another one. Food security is another one. So what you have is a system right now that's being shaken, and we're having to redefine all sorts of relationships on that. That is a strong signal, and it comes on top of course, a complete change in paradigms, both in terms of how we think globalization is going. It's no longer the ever closer integration of goods, people, and finance. It's now fragmentation. And domestically, I grew up in a simple world that had something called the Washington Consensus, that most countries agreed that the path to prosperity is deregulation, liberalization, and financial prudence. And today we have industrial policy, we have tariffs, and we have fiscal irresponsibility. So, these are fundamental changes to how we do things that are going to impact the system for a long time.
Was the simpler world, the Washington Consensus, a better world? Or have we yet to find out?
We yet to find out. It was an incomplete world because we lost sight of distribution. And if you lose sight of distribution, then you alienate people, you marginalize people. And in the process, you plant the seeds for the destruction of whatever system it is. People will tolerate, to a certain extent, the inequality of income and wealth. But it's when the inequality of opportunity becomes really problematic that people push back. And then you get the single issue voter. And we've seen this, and that has massive political implications. And alienating and marginalizing important segments of the population has huge social implications as well.
Yeah, absolutely. And from what I read, AI is a big part of that. So we're talking about signal and noise. We're talking about the AI bubble. Is the AI bubble a signal or a noise?
So I'm not sure it's a bubble, to tell you the truth. Okay. There's certainly a lot of hype. There's certainly valuations that you look at and you think, can that make sense or not? But if you look at the fundamental drivers of this AI revolution, you sort of think, you know what, we're still early on. One, of course, is computing power, and computing power is increasing still at a significant rate. Two is expertise. Three is private money. Now, at some point, there will be what they call a data wall, where we'll end up having utilized all the data. We're not there yet. And there'll be an energy wall as well. But that's down the road. I'm always struck when I talk, which I do often, to people who are at the forefront of this innovation and say, what do you think it's going to look like in 12 months' time? And they say, Mohamed, I don't know. It's changing so quickly. What we're doing today wasn't even on the radar screen 12 months ago. So, I'm actually excited. It doesn't mean that we won't have casualties along the way, but I do think that this is a fundamental transformation going on.
Excited with a little bit of anxiety, or just excited?
Yeah, so this is what I call an 80-20 proposition. 80% good, 20% bad. And then depending on where you are in the world, you get different behavioral reactions. So in the US, you show an innovator something that's 80-20, they'll tend to ignore the 20 completely and focus on the 80. And by the time they focus on the 20, there's already been damage done. And we saw that with Google, with Facebook. Go to Europe, show 80-20, and then people obsess over the 20 and want to regulate so much that they lose sight of the 80. And I think that this is an 80-20 is something that has to be embraced fully. You have to balance your 80 with your 20. Of course, you want to unleash the 80, but you also have to risk manage the 20. And I think that we can able to do so. For example, with labor, most of the AI is labor augmenting, not labor displacing, labor augmenting. And that's really, really important. I can tell you in education, AI holds the promise to provide first-class education to people who would not have access to it otherwise. You're not displacing teachers, you are enabling teachers with material that adjusts to what the people can and cannot do in a way that makes the teacher much more effective. Otherwise, actually, the teacher would probably lose the kid from school completely.
Yeah, it's got an incredible opportunity for everyone, I think, especially to expand their own knowledge. Do you think, I'll bring you back to, bring us on to central bankers and their task to rebalance the world? That's probably not the right phrase, but they've got a big decision, certainly in the West, to try to figure out where interest rates go over the next 12 months. Is that the biggest challenge we're facing?
I think if you're in a central bank, you have three challenges. One is normalize. You've run monetary policy with floored interest rates, enormous injections of liquidity. You then missed a major turn, and you had to tighten monetary policy significantly. And now you've got a, quote, soft land. So there's a whole sort of monetary policy element. The second is financial stability. We have segments of our financial system that are extremely vulnerable. And most of those segments are now outside the banks. So there's a very important need for the regulators, the financial regulators, to understand how these non-banks operate and also understand the linkages. And then the third element is the payment system. The payment system is actually changing quite quickly, and central bank have to stay up with that. So, they've got a big job, but they are no longer responsible, as they thought they had been for a long time, for delivering the big macroeconomic outcomes. We've discovered that finance whether it's private finance or public finance, cannot deliver durable productivity gains that result in high, inclusive, and sustainable growth. They can give you a sugar rush, but they cannot do the fundamental work that needs to be done to improve productivity.
How much concern do they have over cryptocurrencies?
So it depends which central banks you speak to. The Fed is more hands-off. Some other central banks have embraced it completely. You even have one central bank that is taking it as legal tender on there. So you have the whole range. I think we're experimenting right now with this notion of a central bank digital currency. But I tell my friends who are very keen on Bitcoins, you got to be balanced. Of course, they're going to exist as part of the ecosystem, but they're not going to be a global currency. Central banks will not give up the issuance of currency as one of their prerogatives.
In our lifetime?
Yeah. I mean, it's very, very powerful to be able to issue your currency. So don't expect any central bank to give that up easily.
Yeah, absolutely. One thing I also wanted to ask you about was you have a broad range of views. Where, if you're an investor, which regions do you think look attractive at the moment?
So I find it hard to define regions. I think in terms of risk factors. So the question is, where do you get a set of risks that you are over rewarded for, that the returns that you're getting exceeds the expected risk? And it can be in a region where there's another risk that is there that's completely mispriced, but in the other way. So we're seeing a lot of that. If you ask me the more general question, right now, the public markets are overstretched. You can get as attractive opportunities in some of private credit, for example, as opposed to the global bond markets. You're taking similar risks, but getting paid significantly more. Lots of people are thinking about new ways to approach things like emerging market investing, that once you think in terms of risk factors, it opens up quite a different universe of opportunities and risk.
Are you more of a fan of private markets these days than public markets?
I am in quite a few constituencies, yes. As I'm now more of a fan of active management than passive management, unless you're simply investing in the top US companies, then you should go passive. We had this world in which the central banks were putting so much liquidity in that every boat went up. And in a world like that, when everything's going up, you want to minimize cost. So you go to public markets, you go to passive versus active. This is a different world. This is a world in which liquidity has been taken out, and there's going to be massive repricings going on. And you need a more active approach to these opportunities.
And as you see the liquidity being drawn out, do you see that being drawn out for a long time, or do you see the central banks having to step in again at any point? Or is that just too difficult to tell at the moment because of everything that's going on in the world?
So there's three elements to this. One is interest rates are going to come down after having gone up very, very rapidly. I'm old. I've never seen the Federal Reserve increase interest rates by 75 basis points, 0.75 percentage points, 4 times in a row. It was unthinkable. That's not what you do. But they were so late in responding to inflation that interest rates had to go up very high, very quickly. So they're going to come back down. Central bank balance sheets are going to continue to contract. So that is going to be sucking liquidity out slowly. And then you have the third element is you have still the lagged effects of interest rates. For example, commercial real estate hasn't fully adjusted yet. So liquidity, even though interest rates are going to be coming down, liquidity is not going to suddenly feel more ample than it is right now.
Fantastic. Thank you so much. So the last part of our show, we always talk about the book itself. So forgive me for this because it'd be some of it self-aggrandizing. I'm going to ask you a question. So your book won the Business Book of the Year award back in 2008. What do you think makes an award-winning book?
So you should ask the judges. I can tell you now because for the last, I don't know, 7, 8 years, I've been on the jury. So I can tell you what make it. But I remember that day when I was running around. The award ceremony was that evening, and I was sitting at the table with the publishers, and it's the closest I've ever gotten to the Oscars. And had you asked me, what is the probability of your book winning? I would tell you low to de minimis. So just sitting there wondering which of the great other books were going to win. And suddenly I hear the name of my book and I hear my name.
Did you have a speech prepared at all?
I had no speech prepared. I had nothing prepared. I was in a bit of a daze. The table went crazy because it was a publisher's table. I got up, I went up, I shook hands, and I remember all I'm saying is thank you very much. And then I said, this money will go to 2 charities. And I chose the charities at that time when I was up there. And I went back and sat down. Since then, I've witnessed people come up and talk very elegantly about their book. I did not do that because I simply wasn't ready at all.
I was going to ask, did it have much impact on your career, the reception of the book?
It certainly helps the book. There's no doubt, and there's a lot of evidence on that it makes a lot more people read the book than they would have otherwise. The FT Business Book of the Year is a very respected competition. I have found the books on the long and short list absolutely fascinating to read. And some of the winners, I wouldn't put my book in there, but some of the winners have been absolute classics that people are still reading today.
While you were writing, bear in mind just how quickly the world was changing. I think probably quite a lot of people don't remember how quickly the world was changing at the time you were writing it. Was there any challenges or memorable moments during the writing of the book?
I mean, there was a sense because if you remember, I mean, the whole thesis of the book, as we talked about, was that finance had gotten too big, way too big for the economy, and there was a lot of risk taking that made absolutely no sense whatsoever, and that the sector was now feeding on itself, and there would be a market correction. When markets collide, they will collide with the reality that what they're meant to serve is too small for that. So I was writing it, and just as it was coming out in March, we had the first real tremor. And I thought, oh no, before the book is even out, what I'm worried about is going to play out.
Yeah, now, markets crashed, didn't they, at the time?
They crashed, but then they came straight back up because the bank that was in trouble at the time, Bear Stearns, got taken over by JP Morgan. And JP Morgan had a very strong balance sheet. So overnight, people thought that the risk had disappeared. But again, people weren't disciplined enough to ask, what is it that led to this problem? And of course, 6 months later, we had it in Lehman Brothers. We had it in a number of instances. And again, the initial attitude was, well, it's temporary. Of course, it proved much, much more meaningful than that.
When you were writing it, were you worried that anything you were writing might be dated like in about 2 or 3 months' time?
Yeah, I mean, that is any author's nightmare. That you see something coming, and by the time the book, because it takes I didn't realize how long it takes for a book to be published. I mean, it's a ridiculously long process.
Yeah, all the editing and everything that goes into it, and proofreading.
The editing, the proofread, the galleys that go back and forth. It takes, and then the publisher have their own considerations. So they have certain books that they want out at certain times. And also they have views as to when is the market receptive to certain books. So when you put all that together, it normally takes much longer than you ever anticipate, certainly than I anticipated.
So it brings you on perfectly to the very last question. Bear in mind how long it takes to get a book out. What's the one piece of advice you'd give any aspiring writer?
Sit down and write. I wasn't a writer. I've now found that it's a relaxing. I love it. It helps me relax. Sit down and write because it helps you discipline your thoughts. It helps you organize a lot of your thinking. I have found it extremely useful to write things down, even when it's just I'm needing to make a decision. I said, what if I was writing an article? And it goes beyond. We had someone come and talk to our students. And of course, the first question a student asks when they have someone from a company is, how do I end up in the best job I want to be in? And this person said, whatever that job is, imagine that you're writing the press release that explains why it is you got that job. And if you write that press release, it will say that you did this and this and this in order to prepare for this job. And that's your guide to what you want. And I thought it was brilliant. Just try to write a draft press release to organize your thinking.
Perfect. Sage advice. Mohamed El-Erian, thank you so much for joining us.
Thanks for having me.